Hi, everyone. Thank you for joining our final lecture of the DeFi course. Today, we will speak about the decentralized derivatives protocols. First of all, we start with a few phrases of John Maynard Keynes, which is very well-known economist. And what he said is that stock market is like a newspaper beauty contest. What does it mean? It means that when you are going to choose flowers, actually you take the flowers you like. But when you go on the stock market and choose some shares, or you go to the crypto market and choose some tokens, actually it doesn't matter what you like. What really matters is that what everyone else likes. So that is why stock price is determined not by investors' own beliefs, not what you believe in, but by their beliefs about others' beliefs. And if you are quite correct in estimating what other people like, then you will be rich. You will be always buying the market, the stocks or the tokens or something else, which will increase in value during the time. What is derivatives? Actually, this is a contract in which the value is determined based on the value of another asset or underlying asset. It might be stocks, indexes, commodities, currencies, tokens. These contracts can be used to protect against the risks, price volatility, speculation, of course, and the portfolio management. And in the classical way, we can talk about a few types of these financial instruments. It's forwards, futures, options, and swaps. So forwards, futures are contracts to buy or sell an underlying asset at a predominant price and date in the future. Options give you not, actually, you're not buying, but you have the right to buy or to sell some underlying asset in the future. Going next, first we start with the definition of what is leverage. You know that on some centralized exchanges, it's possible to use so-called leverage. You might be interested in what it is. So actually, leverage gives you an opportunity to buy the token or a stock or something for the larger amount. It means that when I just come and buy one Bitcoin, today I have to pay $30,000 US. So when I pay $30,000, I get one Bitcoin. But when I use leverage, it is possible to have, for example, $3,000 US. So it's 10 times less. But if I have 10x leverage, I can buy one Bitcoin and my exposure will be $30,000. But that's not so easy. Here is the example. It means that when I use this leverage, it means that if I have 10x leverage, when the price of Bitcoin is increasing, I get the same 10x increase in the money I get. So if, for example, Bitcoin is going up 2 times, so it was 30,000, then it's 60,000. It means that I have this plus 30,000 net profit for my 3,000, which I invested as a leverage. But if Bitcoin goes in another direction, it's going to fall, then I lose my 3,000 very quickly. So that's the drawback of using leverage. And you might have seen the movie Margin Call. It's actually the market definition, which means that we have initial margin. This is the money I invested. Then I have 10x leverage, and margin call when my margin, my 1,000, falls below a certain threshold, and I'm going to be liquidated. So I have to add more money to the margin, or I have to actually close the position, and it means that I admit all losses and I lose everything. So you have to understand that on the classical markets, the large banks, investment companies, they use lots of leverage. And when the market is not so volatile like our crypto market, when it's less volatile, stocks, maybe bonds, maybe something else, you can use 100x leverage and be quite safe in this environment. Liquidation, actually, this is when you have the losses which are not covering, not covered by your initial margin, and you are forcefully liquidated. And P&L, that's the profit and loss. This gives the trader an overview of his position, if the trade is profitable or unprofitable. So again, when we use leverage, we have to be very cautious, and we should understand that our profits and our loss are multiplied by our leverage, 10x. And if Bitcoin is falling by from, let's say, I have $3,000, I have 10x. I bought one Bitcoin for $30,000, $1,000. Then Bitcoin is falling only for 3,000 to 27. That means that I have zero initial margin and I'm liquidated. So that's the reason. Plus, you have to pay the fees for the platform, which gives you this leverage. Now let's move to another concept which called short sales. What does it mean? When you simply buy, as in the previous example, Bitcoin, that means that I have a long position. Long position meaning that I had the cash, then I bought asset, and I'm long in this asset. So I'm expecting that this asset is gonna rise. The value of this asset is gonna rise during the time. But on the financial market, you can play on another direction. So you can bet on the falling price of the asset. This is a short sale. How does it work? It works in a way that at certain moment you like borrow from someone shares or tokens or something else and sell it. So you borrowed 100 shares of something and sell it. So you have the cash. Then if you're right and price is going down by certain, let's say 200 points, you can buy the same asset and return the loan. You can buy this 100 shares with the new lower price and return the previous loan. So you have first state when you borrowed 100 shares and sold it. For example, you bought 100 shares for $10 each. So you have a position of $1,000. Then your shares fall in the price from 10 to $8. And what you can do, you can fix your position, close your short sale, and how much do you earn on this position? You have $200 profit because you buy this 100 shares for $8 each. It costs you 800, but before that you sold it for 1,000. So 1,000 minus 800, you have 200 profit. So this is the short sales. That's the example which describe just what I told you, but with the case of a Bitcoin. What else? In the crypto market, we also have so-called perpetual futures. Simple futures are contracts that are like agreement that you future at a certain price, but here this perpetual futures are like they don't have the expiration date. That's a special instrument which allows crypto platforms to build different derivative products, derivative financial instruments, like I just talking about, like short sales, long positions, and the leverage. That's just the mechanics which is used for the crypto markets. Okay, now let's go to the first perpetual decentralized exchange. It's called GMX. Initially, it was deployed on Arbitrum network, and we are gonna look at the specific position which we can build, positions which we can build with this protocol. So first, let's try to take long position with the leverage of 5x in Ethereum. So it means that I pay, or I give to the platform 1 Ethereum, and the platform allows me to take a position of almost 5 Ethers. But the most important thing is below. So it means that the entry price is $1,751. That was the price of Ethereum at the moment when I took this screenshot. But again, if I use leverage, it means that if the price of Ethereum is going up, that's good for me. I'm earning money. But if it goes down, I can be liquidated. And the liquidation price is 1,400. So it means that plus I have to pay fees, about $8 fees. It means that if I'm wrong in my price projections and the price goes down below this threshold, my position will be liquidated, and I will lose my 1 Ethereum. Now let's speak about short. Of course, that's the price of 1 Ethereum in US dollars at the time of the screenshot. So again, I pay not 1 Ether but USDC when I try to short Ethereum. I have about 5x5 Ethereums in short position, and here on the contrary, when the price of Ethereum is going down, that's good for me. I earn on it. But when the price of Ethereum, because I'm shorting, is going up, that's very bad for me, and I will be liquidated at the point of $2,085. So as soon as the price of Ethereum will reach $2,085, my position will be liquidated, and I will lose all my USDC which I put in this position. Well, if I decrease the leverage, and the minimum leverage I can use for GMX platform is 1.1, you see that significantly decreasing liquidation price. Again, the same story. I want to take long position with 1 Ethereum. 1.1 means that I get position of almost 0.1 Ethereums, and here the price of Ethereum should fall to $176 for me to be liquidated. And the same story for the short position. If I'm taking position 1-to-1 and short Ethereum, liquidation price is going to be $3,300. So you see, the more leverage I use, the riskier I take the position. If I try to take the leverage of 50x, so it means that even not significant fluctuations of the price will knock me out. But if I write in terms of the price, direction of the price, then it means that I can get lots of profit, huge profit. So GMX is a decentralized spot and perpetual exchange, and it has 2 tokens. First is the GMX token, That's the utility platform token or governance token. And 30% of commissions received from swaps, leverage trading are converted to Ether and paid to the GMX holders. And we have second token, GLP. That's the liquidity provider token. And of course, actually everything we trade on our GMX platform, of course, when I try to take a short position, I have to borrow certain assets, and these assets are taken from this GLP token structure. And GLP token holders get 70% of the commissions received from swaps and leverage trading. And you have to understand that the fees, that's the line below, almost $2. Here it's almost $9. These fees are going to the holders of GMX and GLP token. So what's the structure of GLP token? If you want to be liquidity provider of GMX, you can actually add one of these assets, and actually these assets are traded on the GMX platform. So you can short along with Ethereum, with Bitcoin, Chainlink, or Uniswap. And the structure is the same of the GLP is completely the same. They have almost $500 million in this asset. And that's actually the price of the GLP. It's quite close to the $1 per one token. And why it's not volatile? Because it's half consists of volatile tokens, and the other half is a stable coins. So it's about 27% Ethereum, 19% Bitcoin, less than 2% Chainlink and Uniswap, and 45% USDC, DAI. So it's 50-50 with the stable coins. Profit distribution, that's we already discussed. 30% of the fees from the platform trading goes to the GMX, 70% to GLP. And here you see that the APR, so the profitability of GLP token is about 20%. That's quite high, but we have to understand that this is not a stable coin. The GLP is only half consists of the stable coins. The other half is the volatile Ethereum and Bitcoin, and it has only 6% APR for their governance token. It's quite successful platform, and actually we can estimate it from the growth of the GMX token. It's $77. Now it's maybe different, but you see that it increased for a year by maybe 2.5 or 3 times. The next platform is Quenta. And if we were talking before about the leverage, long and short positions, here we talk about options. So what are options? An option is a contract between two parties under which one party, the option holder, has the right but not the obligation to buy or to sell a specific asset at a certain price, known as a strike price. So it means that when you buy an option, actually you pay a certain premium for the right to buy or to sell in the future a certain asset. Let's have a few examples. Let's first of all talk about so-called call options. So there are 2 types of options, call and put. Call options, that's the right to buy, or sorry, that's the right. Yes, that's the right to buy an asset at a specific price in the future, and the put is an option, actually is the right to sell a certain asset in the future. And as we talk, so if I pay a premium for the call option, and the price of the asset is going up, this is good for me. And I actually choose the current strike price for my asset. Let's have an example of Bitcoin. For example, I buy call option for Bitcoin with the strike price of 30,000 US dollars as it is now, but in the future, let's say in half of a year, in 6 months, and I pay for this option 500 US dollars premium. It means that in half a year, it means that in January of the next year, I have a right to buy Bitcoin with the price of 30,000 US dollars. I paid for this right, for this option, 500 US dollars. If the price of Bitcoin at that moment will be, let's say 40,000, then I have a profit of 10,000 US dollars because I buy this Bitcoin with the price of 30,000. That's the conditions of this financial product, this derivative, this option. But I have to actually subtract from 10,000 the cost of the premium, 500. I paid the premium $500, and the total profit for me will be 9,500 US dollars. What's good about options, because it's more convenient than leverage, that's less risky. If the price of Bitcoin will go down and it will cost, I don't know, 10,000, I should not buy it. I have a right to buy it, but I will not do it because I can go to the market and buy it for the 10,000, not 30,000. Only thing I lose is my premium, and we hear it and we see it in this graph. So your losses are limited by option premium, but your profit are unlimited if the asset is going up in the price. So this is the call option. We have other side. So we have, if you are buying call options, it means that someone is selling them to you. These people are getting this premium and they have an obligation to sell you this Bitcoin in the future at the strike price if you want it, if you will want it. They get the premium, they get 500 US dollars right now and hope that the price of Bitcoin will not go up. So this is the sellers of call options. When we buy put option, that is the situation when we actually thinking that the price of the asset will go down, and we buy a right to sell an asset in the future. Let's think about the same story. Let's think about Bitcoin, and we buy put option with the condition to sell this Bitcoin in half of a year for with the price of 30,000. It means that we think that Bitcoin will fall in the price. What happens if this is true and the Bitcoin is gonna fall in the price? Let's imagine that in half of the year our Bitcoin costs not 30 but $20,000. But we have an option, we have right to sell it for 30. It means that the same situation, we are in profit for 10,000 US dollars and we paid 500 US dollars as a fee for our option to those people who sell it to us. It means that the total profit is 10,000 minus 500. We have 9,500 US dollars. So you see that these financial instruments, these derivatives, allow us to hedge risks. So we can use these options. And here again, loss is limited and the profit is not limited. Well, it's limited by the fall of the price of the asset. It can fall only to the zero, actually. It cannot fall to the minus something. Okay, someone is selling option to us, and of course they get this premium the same as the situation with the call option seller, but they have not limited their losses. And the Quanta allows us, that's the data for April 14th. I made this screenshot in the past, and we see the situation when you are going to buy a call option. So that's the right to buy asset in the future. And what we see here, that the lower the price, that's the premium price, that's the premium. The higher the premium. And that's true because you have to pay $340 premium to buy, let's say in 2 weeks, Ethereum for $1,500. But the current price is 1,800. And we see here that if we add the strike price with the premium, we get price higher than the current price. And of course, on the contrary, if we are gonna buy call option, the right to buy asset in the future with the higher price than we have today, $2,300, we have very low premium of almost $20. So no one expects that the price of Ethereum will go too far, and that is why they are ready to sell us at minimum premium this option. So this is a situation for the option seller. So if you want to sell call option, you get actually a little bit less premium. The difference goes to the platform as a profit of the platform. Now let's look at the put option. If I'm gonna buy put option, that's the right to sell Ethereum in the future at certain price. That's on the contrary. If we will want to sell Ethereum in the future in 2 weeks, for example, for $1,500, then we have to pay only $24. But that's obvious because no one expects the price is gonna fall from this level to this level. It means that if the price will be somewhere over here, over $1,800, then you will simply not use your option. You will not use it because you can sell your Ethereum for a high price. And the premium is extremely high, almost $500 if you want to buy a right to sell your one Ether for the price of $2,300. So that's, you have to play with these figures, but it's obvious there is a very solid economic logic behind these instruments. What you can do using these instruments, you can actually build very sophisticated strategies. For example, you can actually bet on a certain market. For example, you might earn on the market if you expect it to rise. You can earn on the market if you expect it to fall, or you can earn on a market which is not changing in time, so it's just fluctuating. So this is the prices you get if you want to sell the put option. So it's a little bit lower than for the buyer, but that will be your profit, your premium. And the last thing I would like to say is that there is a certain formula for the call and put options. It's called Black-Scholes model. It was invented maybe 50 or so years ago. So it's about mathematics. And of course, this instrument not used, not just used in the crypto world. So there's huge amounts of these derivatives are used on the classical markets, with the classical stocks, bonds, currencies. And here we see that in October 1997, the guys who invented this formula, Scholz and Merton, received the Nobel Prize for the new method to determine the value of derivatives, and specifically the options. So that's it for today. Thank you for your attention. If you have questions, I'm ready to answer. Thank you.
Okay, thank you so much, Serhiy. Thank you so much, all of our listeners, our students, and please waiting for additional information about our exams, our certificates, and final quiz, and other. So, thank you, and see you soon.
Goodbye.
Bye-bye.